First tell me how it all started.
Thank you, Dhirendra. So to begin with, it was very early in my life and I had some kind of fancy, if I may call that word, towards equities market. That was when I was maybe less than 10 years old. And then at that juncture, I would ask around, particularly the elders, what is it that it means. So I was told that it is a part ownership of a company, but my inquisitiveness didn't go down. So people advised me that if it is something that you want to further get to know of, then you might have to do an MBA in finance at some later juncture. I said okay, and then in the meanwhile, during my graduation days.
Now tell me about your childhood curiosity. What will be that question?
So to be very specific to that, what I would say.
Whom would you ask the question, and what will be that typical question be, if you can?
Yeah. So what used to happen is, as a child, you would go to school, and in the evening you would look forward to the time to play. So the afternoon is something that you're not supposed to go out, but study or do something. So I would typically pick up the newspaper. There was no internet in those days. And I would flip the newspaper, read it. There used to be this page with a huge number of names and numbers.
Top listing.
Yes. Now it doesn't happen, but then in those days it used to be there. And everything else was something that you could understand. That was something that I would wonder, what is it? Company names are written. There are 4 codes, high, low, and all that. And then I would ask, particularly my father, that what is it? He would say, too early for you, why don't you study? And I would say, no, but what is it? So he said, it's a part ownership of the business. I'm like, okay. But then as I mentioned, it went on, and then I kept on reading. There came a point wherein I felt confident myself during my graduation days to invest some money. There used to be no demat those days in physical.
Early 90s.
Early 90s, yeah. And then that share certificate just got kept. And the benefit of it, I realized, the so-called long-term investing that we talk about in equities, when I could fund my management education mostly through the investment that I had done in equities.
When did you make those investments?
Almost 7 years. 7 years is what it took. So beginning of graduation all the way, I worked after graduation for 3 years, and when I pursued my MBA, that money had swelled decently enough to be able to fund partly the education itself, which was quite helpful. So that's the closest brush initially.
Quite curious to know about those companies, but we'll come to that later.
Yeah.
How has your thought process evolved since then? Or, was there any thought process to those things which funded your graduation, your master's, your MBA?
So if the first investments I made, there was no great thought process when I look back in hindsight. It was more to do with what I think was a great story. And at that juncture, I clearly did not know investing is not about story, it is about what price you pay. It's investing your money, so it's important that you evaluate on various parameters. That formal education came to me post graduation, when I read books, and then finally when I pursued formal education in that field in my management program. But then, to be candid, the first investments were more story. Maybe I was lucky to have put money into some names, and I can take those names. I remember one of the names, besides others, was there was the Cross Private Sector Bank. In that time zone, there were new private banking license given. So there was this name, Times Bank, which finally got amalgamated into HDFC Bank. But then that was one of the investments I made, which did quite well for me. There were some preferential shares, I remember, that got issued even to retail investors. In those days, it used to be called, I think it's still like the Tata Tele Services. And in mid-90s, telecom used to look like a great thing, because you had to wait for a lot of time to get even a PNT line. I remember a lot of people used to write PP.
Yes.
And PP used to mean pass pados.
Yeah, pass padosi ka phone. So yes.
So yeah, it did well, but there was no method. The method came much later. Yes.
So when did you actually, what was the step to, thinking about value deeply and getting apprehensive about story stocks? Story, because stories are still relevant. It starts with the story.
At the end of it, stories are the beginning point. Every buy idea, every sell idea has a story behind it. There is a thesis, if I may use a more formal word. It has to be quantified. That's very important. Investment is about generating profits or returns, and that's a function of the right numbers. There is a thesis all the time. So it matters, and I learned it the hard way, having made mistakes. Very initially in my personal investing experience, that was pre-MBA, and then clearly having seen some cycles, the tech bubble particularly made me more conscious about that. There is something big and important that I am missing. It's not the story that matters. It is important, but that's not the only thing that matters. It is about what price you pay, and when I dug deeper, I realized the basic principles of value investing started getting into my investing framework, or the DNA, if I may call. And then over a long period of time now, 15 years plus, I have seen them work so beautifully through various phases that my confidence and comfort on that style of investing is far more cemented now, and I believe that that's, amongst other things, amongst the very good ways of generating good equity returns for long-term investors.
Can you cite an example of the mistake and what you learned from it?
Yeah, so typical mistake people would make in the
buying a great company at a fancy price.
Exactly. So this was pre-tech bubble bust, and tech seemed like the great thing that's going to happen to mankind, and clearly amongst,
and it is.
Yeah, it is, no doubt about it. So that's exactly the point. So amongst the various tech names that were listed and were continuously galloping at that juncture, I was into 3-4 names, and post the
metaphor DFQs besides Infosys and Satyam.
So not these names exactly, but
similar names or popular names of
clients. Okay. So the kind of names which felt like they would just
change the world,
achieve the escape velocity. So when I look back, one or two of them just perished. And then when I analyzed the entire thing, what is it that went wrong? Clearly, story was not the thing. Story was applicable to all of them. Yes. What came across on the fore was the importance of balance sheet. Not all businesses that went down were courtesy the mistakes they made. A lot of businesses didn't have the wherewithal to deal with a bad phase. With no wrong intention on the entrepreneur's part. It is just that they weren't prepared for a bad phase, and the bad phase dawned upon them and they couldn't deal with it. It lasted longer than they thought. Very few, you don't have to only learn from your mistakes. When you look at the other stocks which you had looked at, and when you realize quite a few of them were unworthy of being considered investment worthy itself. So deep thoughts went into it. It clearly the outcome was you need to formally take an education in that direction, and there is much more than the story that matters in making returns.
So how what are the 3-4 things that you see, or what are the things that you see now? After all this learning, all the understanding, and knowing that your thinking has tilted towards looking at something more fundamental, what are the 2-3 things? If you do have a checklist, what do you see?
So in the last 17 odd years, particularly, I began initially with making a much bigger checklist, and as I stand today, the checklist has compressed, but then it has become far more relevant and powerful. Amongst the things that matter a lot more is, besides the price that I overemphasize so much, price is what you pay, so that's number one. It's also very important that what is the attitude of the management or the promoter towards minority shareholders. Okay. Extremely important, because you are a minority shareholder, you be through a mutual fund route or be it direct route. And you have to focus on the balance sheet. Very often I have seen in euphoric times, people tend to deprioritize balance sheet. Balance sheet is extremely important. Cash flows, ability of the business to sustain through bad times. Is there an intrinsic value that the market is missing? And that requires you to do a thorough work on a huge period of historical annual reports. It's actually not so difficult to see what the management is trying to say and do. You can just pick up beginning with a 10-year-old annual report of the company and just see in the MDA what they have been saying and what they've been doing. You could just simply do a performance analysis over and over for last 10 years and you'll get a very fair sense of how things have been. You can look at how the business did in the last bad time. So a historical analysis of the balance sheet, annual reports, cash flows, particularly, and in the end what price you pay. A lot of assumptions. The financial market is filled with assumptions which can be very easy to move up and down in a huge amplitude. The key as a value investor is the margin of safety. Every assumption cannot go right. It's human to have wrong assumptions for various reasons, need not be of your fault. The whole key is to use least number of assumptions and to use them at the most later stage in your financial projection or modeling. Because the earlier you use, what will happen is there would be something which is mathematically called propagation of error. If you are using, let's say, if I take an example, typically it has been observed that if GDP grows at above 6%, cement demand is 1.2 times GDP. But if it falls, GDP falls below 6%, then the cement demand compresses to 0.8 times GDP. So based on the GDP assumption, if that is how you are modeling, you would get a huge dispersion on the cement requirement demand itself. So if you are considering a cement stock and you assume that okay, GDP is unlikely to grow above 6% and it still makes sense for me to buy, then there is margin of safety, because if cement or GDP grows higher, cement demand will pick up more, so you will make more money than lesser money. But that still is a problem of plenty and is a good thing to have. So having the right margin of safety rather than beginning with an assumption that GDP will be 9% and so cement demand would be 1.2 times that, and that is, I think, asking for trouble. You would rather have safer assumptions, and if it still makes sense, I think you've got a winner at hand.
So the checklist that you are saying, you look at this attitude of the management towards minority shareholders, margin of safety. What else? How do you define a, balance sheet is important. How would you define a quality business?
So over a long period of time, I have seen that highly leveraged businesses have to be very carefully analyzed. The biggest risk that even a good business carries is to have too much leverage at the wrong point in the cycle. Unlike a lot of businesses, most sectors are cyclical in nature. Because economy itself is cyclical in nature, so the demands can go up and down. And the key is, so I have to be very careful about the leverage. By that I don't mean that leverage is not to be touched. In my investing framework, what I typically tend to like is, if we have a B2C company which has some kind of direct consumer connect, maybe a brand, which is potentially, with my assumptions and margin of safety, expected to grow in double-digit earnings, 10% plus or 15% plus, whatever that number is, for a reasonable period of time, let's say 5 years, 10 years. It can be sporadic in nature, but let's say the CAGR could look in that direction. The longer the horizon, the better. And you have a decent management with a good track record of having dealt with minority shareholders in a fair way. Debt free ideally, but I'm open to some bit of leverage. If you get such things, I guess, I know it's very often I'm told it's too much to ask for, but then you will be surprised when you push the entire spectrum through it, you still get couple of names, even in markets which are very elevated, and then that's all you need.
And then looking for it to be available at a reasonable price.
So reasonable price also has a definition for me. 13p and below is a very good valuation to have for such a business. You get some of what I've seen, you get bunched them, a lot of them all of a sudden when there is a sell down in the market, and you don't get any when the market is too elevated. But then I have also observed that markets, if you have the discipline, are very rewarding. And the greed and fear that market exposes you through, if you deal with that, it's going to be an extremely rewarding experience and journey. This is about discipline. Investing is about discipline.
Working on it, applying your checklist, coming up with a set of stocks, waiting for it to be available on this greed and market cycle of the, greed and fear cycle of the market, and looking. So it's almost like waiting for your prey at your price. In that sense.
Yeah, so you're right, but then the thing is, earlier, maybe 15 years ago, I wasn't very sure that am I being too theoretical, and I wasn't so sure. But then reality is, 15 years later now, it is not theoretical. Okay. It works, and it is not a wait till eternity. It happens. You can be flexible a bit, let's say, need not be 13p, it can be 15p. Because the earnings could not be 10, it could be 15.
But some of these companies could be always, perpetually, fairly priced or reasonably priced to be available at in a manner, so you can just do the waiting.
Well,
do you face such situations?
So I have faced that with FMCG stocks for almost 10 years now. But then we've managed to still find businesses which we've invested into and which have satisfied this criteria, and we've done pretty well. Even without that. Even without
dominant thing.
Yeah.
I mean, how do you estimate the fair value of a business? You will have some number in mind.
So when
market cap or price or.
Yeah, so it's a very good question, Dhirendra. I typically look at the market cap because that's the value that I ascribe to. Even in a leverage business, the way shareholders make money is when the debt converts to a market cap eventually, and which is a function of the business generating cash flows and paring down that debt. So a target market cap is what typically I look for. So my entire effort or work on the financial side is the outcome of it is a target market cap. And then I look at the current market cap and I see, okay, the delta is big enough for me to be patient. In my kind of investing, I have rarely seen a stock I buy and it runs tomorrow. It is to me also a surprise if that happens. Generally, I have seen that if you broaden the horizon and walk into the marketplace, you get a far more pick. So just to rephrase it, I see the market generally leaves a lot of stocks on the table which they think, will have triggers 3 years down the lane or 2 years down the lane. So it seems like, okay, if there is time in the meanwhile, let me try making money somewhere else. And in that zone, typically those stocks drift into a valuation which, in my assessment, justify the patience that I bring on the table. I'm willing to wait. As long as at the end we get remunerated for that patience. So that's the game. And that has worked pretty fine. So it partially also answers the question that you asked me before this, that does it make you wait till eternity? The issue is the marketplace sometimes has too less patience, and I come in with a lot more patience and I see the rewards.
I was talking specifically about fair value. What is that fair value? How do you arrive at it?
So the whole outcome, that is the target market cap, which I define as the fair value, because the market cap defined with number of shares is, that's all the target price would be. So it begins with the question number 1. What is the best way to value this business? And for me that takes the maximum amount of time, because all businesses are not simple, they are more complex. They could have various streams, various risks and various other things. So for me, I have a literal challenge to the assumed way of valuing this business. Why should this be priced to book? Why should this be EV EBITDA? Why should it be priced to earning? Why should this be discounted cash flows or whatever? So the first basic question that I put forth is challenge the conventional wisdom of why is this the best way to value that business? Once that has been agreed upon, okay fine, this looks like the best way to value the business. It could be in line with the way Street looks at it, or something of a mixture that we think in our assessment is the right way. Then we progress on to think about how do we progress on the financial modeling, wherein we have to have least assumptions and the assumptions even at later end. So if the assumption is that okay, GDP is the first assumption, I don't think that's the right way to go about it. We don't have a great hang on this number, so I don't want to begin with it. Let me begin with something else. So these kind of questions we pose that challenge to ourselves or to the conventional accepted way of going about it, and finally we come up with a projection which is more cash flow based rather than a price to earning based, because a lot of revenue recognitions could be different. So within the same sector I tend to normalize things for different revenue recognitions, different debtor days. There is something called the unbilled revenue, because unbilled revenue people tend to ignore, but it is 2 times the debtor days. Once the unbilled revenue gets eligible to be raised an invoice, it becomes a debtor, but then it becomes 2 times. So 10 days of unbilled is equal to 20 days of debtor days. So I tend to normalize that at least between a sector to compare. I tend to normalize also the revenue recognitions that people do. Also look at have they been too aggressive to push the sales numbers and the likes and the balance sheet. So focus on the real cash flows, operating cash flows minus the interest payouts. That's the real number. Try to see if there is something in the balance sheet reserves. How are they trying to capitalize some things which could be hiding the real numbers, and then go ahead and project on a longer basis, as long as possible. Ideally, I don't like 2-year, 3-year projections. I have seen that statistically the chances of research going right on numbers or assumptions is substantially better when you are 5 years and beyond. And in fact, ideally is 10 years. So get a 10-year outlook right. It's okay, 1 year, 2 year or 3 year, maybe you will go all over the place. So get it right on 10 years.
It might not be in place.
Yeah, so we create that margin of safety in assumptions. We try to minimize the errors in our financial numbers. Get the 10-year outlook right. Establish it by the research that why should we have the demand growing at this pace. It might not happen in 3 years, but it will definitely happen in 10 years. And then have finally, let's say, a terminal value if I'm using a discount cash flow. But terminal value as a matter of maybe habit, a lot of people tend to use a 5% number. Then I would question that 5% terminal growth, why is it that it should be there? Why not 3? Why not 2? And then the discounting rate itself. The challenge is the conventional way of teaching discounting is cost of debt, beta and cost of equity. But then if the company doesn't have any debt,
then how do you do it?
So what is the cost of equity? Cost of equity is different for somebody who's coming from New York because he's getting free money practically. And cost of debt is different from a domestic investor because he still gets, my domestic investor, which are predominant customer for us, still gets 7% or 6.5% return.
That's the opportunity.
Exactly. So that they leave away that opportunity and come to us. So clearly cost of equities is higher for us compared to, let's say, somebody who's coming from New York where he's only paying 1.5%. So these numbers could make a difference, and that's the reason we see discrepancies. But then the whole point is, okay, but the reality is this is the cost of equity for us. Do we believe the cost of equity could go down? It could be possible because the debt regime could itself, the interest rates could go down. But then if we believe that it is going to benefit the number, let's not assume that, keep it as margin of safety and see how it does. So those things, discount it, look at it, how does the number look? Are we being too harsh? Being too harsh becomes too theoretical.
Rigorous.
So the rigor is to be real. So we begin with a harsh thing and then we list down the assumptions and see, are we being too harsh? At times you will be surprised, even with such harsh assumptions, you still get a number, you looks like a CMP and it looks like 2.5 times. Oh, you've got it.
So that's what have been the disasters by following this rigorous approach to arriving at a fair value?
So there have been two. The rigor doesn't encompass the management's intent, and that's a very subjective, experience-oriented thing. So in my experience, I've seen that a mediocre company with good management does far better for minority investors compared to a great company with inferior management. So management, so if I have, when I did fishbone analysis for my investments which haven't worked, 70% of them were courtesy management assessment gone wrong. And we learned this lesson quite early in our investing.
Is there any quantitative way to figure it out?
We've not done that in terms of quantification, but then it's a 0-1 thing.
Give me, of course, it's binary that somebody is a crook or not, but Do you get any early symptoms? What, with hindsight, could you think of anything that, if you would have checked this, you could have eliminated the possibility of not having it?
So, clearly, there are some things that raise red flags. In the auditor report, if you read annual reports, there could be businesses where 70% of the revenues could be coming from subsidiaries abroad. So, the auditor writes that we have received audited confirmation for these revenues and all that, and so we just assuming they are true and certifying and if it is a services company, then it raises red flags. I want to be more sure about it. At least in manufacturing, there are ways to check. So we need to be more certain about it. So there could be other things. For example, when you read last few annual reports, there have been companies which have said we are doing this, and they have necessarily done something else. So there is a difference between lying and getting the market wrong. So most CEOs or managements are actually upbeat about their business, so they're optimistic.
Yes.
So it's expected of them that okay, things will be better and we have to drive for it. It drives their energy, and that's a good thing. And you could fall lower on that, higher on that. That's not something that we assess as a problem. But then there have been cases where I've met management in February and I've asked them, will you capitalize this and this? They said no. And when I pick up the annual report in June, and it has been capitalized.
It's a complete mistake.
So, although I would like to quantify, but I don't think attitude towards minority shareholder is 0.5. It is 0 or 1. It is binary. Either they are friendly or not hostile to minority shareholders, or they are. So, for me, it is something that is 0.
So, those are disappointments which you will also face in future, because that is an unknown.
Yeah, so, but we put in a huge amount of effort now
to eliminate those possibilities.
We've been very, I would rate, we have looked at that, we've been very successful in last 7 years particularly in getting the management assessment more or less right.
If you have to ask two things from a management, what will you ask? What you check in a management when you're meeting them or try to know?
So, meeting management is actually amongst the last thing that we do. In my experience, meeting the middle guys or the lower guys is far more effective. In fact, meeting the vendors, customers, ex-auditors, ex-employees is also far more effective. I've seen, particularly for companies which have been listed for long, management could be too smart to tell you what they want you to feel. So, just because the management says something, we're not going to take it right on.
You don't take it at face value.
No. So, in fact, we finally go to meet the management when we are convinced that these are the only 2-3 things we want to know. And that's our agenda. Instead of they telling us what they want to, we are more interested in knowing what we want. And that need not always mean that we have to meet the management up.
Okay. You get those answers elsewhere too. Yeah. Compared to your peers, what do you think is your real differentiating things, or what do you find nasty things about your peers? It's another way of asking the same question.
Well, we are blessed to have very competitive peers, and that's a very good environment to have. And I'm not saying that as a cliche. I think we have a very competent set of fund managers in the mutual fund industry. That's good. Obviously, there is a distinct style that everybody brings on the table, and there is scope for multiple styles to do well at various different phases in the market. It also brings beautifully an asset allocator layer which could help to benefit from all the various styles that exist for the end investor. What is very distinct is also a function of the strengths and natural investing aptitude that the fund manager possesses. So what I have observed for myself, to be very specific to your question, Viren, is clearly my horizon is a far more longer than what I have seen in the marketplace. Value investing is a cliche that gets used very often, but practicing that is not at all easy, particularly in phases which are momentum phases, could be wherein the prices are disconnected to the ground, and that's a test. Unless you have strong conviction, unless you've gone through that phase in the past, you'll find it too disturbing and too distracting.
Do you think it is something which can be one can build an inclination, or and one can get that value oriented, or it's a very natural thing. Either you are or you're not. Do you think it's a kind of value which can be developed over time?
It's a beautiful question, and at times I have felt that it is similar to our leader bonds or made. It's no different from that. There is no perfect answer, but I have started drifting towards belief that it is more natural than something that can be inculcated into somebody.
So after you have done all this exercise, you have done the rigorous analysis, you have picked the stock, you have done all the validation, you have checked that management is not a crooked one. After that, how long do you hold, or when do you sell it?
Yeah, so before the selling comes, we have to buy. The analysis is done. For all you know, the outcome could be that it is 20% below where you think you want to, or the price is 20% above where you think you want to buy. And that is when the game begins. Analysis part is in your control. So you can do that, you can fast pace it, you could be prepared for it, and you figure out, okay, the price I want to be in is, let's say, 10-20% below where it is. And then you peacefully wait, and you always fear that will I miss it for 2%. And which is where I have tweaked the way I go about it. I am focusing on a cost of acquisition. So let's say if I want to own it at 100 and below, and the stock reaches, let's say from 120 reaches 105. So 105 I start not aggressively. But let's say if it keeps drifting down, it goes to 95, then I buy aggressively. Whole idea is that we should acquire a desired weight at a cost of acquisition which is 100 or below. So we don't want to have the displeasure of having missed it for 2% or 5%. So it reaches there, and then this is something that obviously evolved. But before this, you have a clear fair value in mind. Yes. Okay. So that acts as an anchor to your clearly. So, and there's an investment thesis. So it is ideal if you have a 5-line investment thesis. Because then you know if you can explain a buy case in 5 lines. Historically, I have seen that you've got a winner at hand. So it's always a good signal. Yes. So when you get it, before the conclusion of the outcome of the entire work is, this is where we think the stock belongs and this is where we want to buy. And then you wait for that price, and then, as I said, the cost of acquisition is what we target, and we acquire it, and then we patiently sit. It doesn't bother me once I have bought how much time it will take, because our past investments will take care of in the meanwhile. Consistently doing it over and over again, I have gathered high confidence into the success rates of this process itself. What I have to constantly bother is, okay, we don't miss it for 2-3%, because that much error is possible in your assumption. So we do that cost of acquisition thing. Once it reaches a target price, cost of acquisition, which is a range rather than a precise number. So so ideally is okay, this and below is good enough for us, so that's fine. So we start above and this is the same way we relinquish. So let's say when we achieve, let's say, the target price which we believe that belong to the business, we would reassess if we think something has materially changed. Very often that's not the case, but the market by then, because it's a rising stock, has gone euphoric, and then there are enough things that people believe would be even better from here on. Other opportunities. So you take a relative view and need not be very relative. If I believe that to a great degree value is unlocked, what we do is then gradually start selling. So we sell, let's say 200 is the price, wherein I think, okay, beyond that the numbers don't justify. So I might start selling, let's say 200 a little, 210, 220, 250. Maybe it goes to 300. By then we could be empty. The stock could go ahead of that. But in the meanwhile, we'll look for something else. And this rigor of what has been the most disappointment after you have sold? So there have been stocks where we have a multi-bagger. They become a multi-bagger from there also. Okay. So there has been, for example, there has been a case wherein I made 15 times the money. The stock doubled from there. Okay. That's okay. So there it happens. All that it means is we have to consistently keep finding some things like this, and that's fine. And earlier it used to bother me. It's okay, it happens. We don't try to be perfect about our selling price. We don't want to be the price makers in the marketplace either. With size, that's not a desirable thing to do.
So, thank you very much for your time and sharing your insights.
Thank you, Dhirendra. Thanks a lot.